In the previous section, we talked about the various problems that have arisen in centrally planned economies. Now, historically, this has ended with the result that centrally planned economies have largely failed. Right? Those economies that were historically centrally planned end up abandoning central planning. We see this happening, say, in the past few decades in China, where they've gone from a very strict centrally planned communist economy to becoming much more market-oriented and allowing for more entrepreneurship to occur and allowing for, in effect, for individual people to take more initiative in driving the economy. So over time we've seen centrally planned economies fail, and entrepreneurially planned economies, while we're not going to claim that they're perfect at figuring out how to determine resource use, they can actually solve these huge problems in a better way. And as a result, these entrepreneurially planned economies have succeeded and have, in the end, ended up displacing the various centrally planned economies. Right? In effect, what entrepreneurially planned economies can do is deal with the fact that we live in a large, changing world with lots of resources we'd like to use to satisfy lots of different preferences. And an entrepreneurial system is capable of dealing with that very large problem, for the reasons we've discussed before. So now let's talk more about the role of the entrepreneur in this entrepreneurially planned system, and the role that profits play in the system. Now the key point is that an entrepreneur, what their real role is foresight. After all production takes some amount of time. There is a time that passes between when I start producing something and when I get the finished product. So for an entrepreneur to be successful, they have to know what you need before you know that you need it. After all, I would be very upset if, say, I needed a new pen, and I went to the store and there weren't any pens available, and they said, oh no, this is what you have to do. You have to hop on this phone, right, call a number of people and get them to get this production process started, right? So we're going to have to go and we're going to have to extract ink wherever that comes from. I don't even know. We're going to have to go and we're going to have to pull more oil out of the ground so we can process that into plastic to provide the case for your pen. We're going to have to make sure we mine some more metal to get the ball bearing that's there in the ballpoint pen. We have to make sure that we get more metal, so we have to contact the mine to make sure we mine out the right amount of the right type. We have to contact all of the stages in between to make sure that they're prepared so that when these resources are ready for them. So don't worry, we'll have your pen for you in a few years. Right, now, naturally, this would be a rather clumsy way for us to try to organize an economy. So instead, what actually happens is that entrepreneurs develop this foresight and say, well, we understand people like to write. We think that something they may like to write with is a pen, so they make a guess. They say, well, probably people are going to want roughly this many pens. So we start the production process. And we started in enough time, we actually produce the pens before people want them. So when I go to the store to buy a pen, all I have to do is pick it up off of the shelf, right, pay for it, and I'm done. Right? It makes things much more convenient. And so those entrepreneurs that are really good at figuring out what people want are going to be the ones that are successful and actually end up selling to people. Now let's turn to the role of profits. I want to point out there are two different types of profits. For those that are already familiar somewhat with financial statements, you're familiar with the first type, what we call accounting profit. Accounting profit is really just you take a business's revenue, that is the money they bring in from sales, you subtract off the explicit costs. Explicit costs would be any cost that actually takes money out of your pocket. So we have in mind here things like wages, materials, payment you have to make to maintain machines, or also depreciation of machines, which is really just money you're setting aside because eventually you have to replace machinery as it does wear out. So these are all considered explicit costs. Right, so accounting profit is revenue minus explicit costs. It basically is a measure of how much actual money is coming in at the end of the day after you've paid all of your expenses. Now we use this for taxes and for reporting because it is something that is very easy to observe. We can actually watch. Here's the money that came in, here's the money that went out. We do the subtraction, here's the difference. So it's very useful for these things where having a precise number is very important. There's a second type of profit we call economic profit. It's very similar in some ways. We start with revenue, we subtract off cost, but in this case we include not just the explicit cost, those things that take money out of our pocket, but also what we call implicit costs. Implicit costs really try to capture the idea of opportunity cost but apply it to a business. So we might include in this things like a normal level of profit. So while it's true you're running this particular business, the reality is you could also be running other businesses. Right? So that's an opportunity you give up when you choose to run this business. So we should subtract off what we would call the normal level of profit, the level of profit you could normally expect to earn running an average business. Or another alternative, instead of putting money into this business, you could put it into the bank or into some kind of interest-bearing account. Part of what you're giving up when you're in that business is this interest that you're foregoing. So things like normal profits, foregone interest, if you were actually using your time to run the business, any wages that you could possibly earn, that would also be considered part of the implicit costs. Now we believe as economists that economic profit is really what businesses use for decision making. Right? Just to consider a simple example, suppose that you decide you're going to run a business, and it takes you a good 8 or 10 hours of every day of the week to run this business, and then you take all of your records with you to the accountant, and they say, well, I have good news, you're making $1 every day. Do we think you're going to stay in business? Well, now, technically speaking, you're not bleeding money. You could stay in business if you wanted to. But economists would point out that you probably have better opportunities out there. For example, you could pick up a few hours a week in a minimum wage job and end up better off than working full-time earning $1 a day. Right? So, that being the case, economists would say, no, you're going to shut this business down. It's not making enough money to be worth it. And the way you determined that was on the basis not of your accounting profit, but of your economic profit. So in this case, your accounting profit is positive. That's that $1 a day. Your economic profit, though, is negative. Because once we subtract out all these opportunity costs, what could you earn from other opportunities, like working for someone else, your economic profit is negative. Right? So while it is true you're making money in the accounting sense, it is also true that you are worse off than you would have been had you done something else. So you're taking a loss in the economic sense. And that's why we think that economic profit is really being used for decision making. So that's what we'll focus on in this course. Now the key assumption we make then, as I mentioned before, is that firms are going to try to maximize their economic profit. This is really just a way of saying that firms are looking for the most profitable opportunities available to them and are looking to seize those opportunities. Now let's talk a little bit about the social role that profits and losses play. I want to make the claim that socially, profit maximization is actually typically a desirable thing. That is, we want businesses to go out and try to earn a profit. Now, to get into why, let's think about what profits actually mean. Right. Well, first, we start with revenues. Right. Revenues, we can understand, would be impacted by the value that the consumer sees in the product you're offering. Right. So, for your revenue to be high, it suggests that either you can charge a high price for your product, which means there's at least some set of people that really, really wants it and is willing to pay a lot for it. So it's very, very valuable to those consumers. Or it could be that you have very high quantity. That is, that you're selling a lot of your product to lots of different people. In that case, we know that the product is valuable, maybe not extremely valuable, but is somewhat valuable to lots of people, enough that they're willing to pay something for it. Right? So revenues, high revenue suggests that there is either very high value for some consumers or that there is at least some value for a very large set of consumers. Either way, you're creating a lot of value if you have very high revenue. If you have very low revenue, that suggests the product you're making isn't worth very much to very many people. So you're really not producing a product that's worth much. Costs, on the other hand, are impacted by the value of the resources you're using, either to their owners or to other entrepreneurs. Right. So, for example, it might be that I could produce something, but in order to do so, I would need a very specific person to do it. Say, I don't know, Brad Pitt. And Brad Pitt's time is extremely valuable to him, so I'd have to pay him millions of dollars to get him to devote the time necessary to produce this particular product. Right. Now, in that case, right, the key point is that Brad Pitt's time is very valuable to him. Right. So as the owner of his time, it's very valuable to him. So it might be that it's not worth it for me to produce this thing simply because the resource is very valuable to the person that owns it. Or it might be that the limit is placed by other entrepreneurs. So it's not so much that Brad Pitt values his free time as that there are other people out there that are making movies that really think that Brad Pitt would add a lot for them. So for me to get Brad Pitt's time, I have to not just pay him enough for him to say, yeah, I'd rather do this than sit on the couch. I have to pay him enough to outbid all of these other entrepreneurs that would possibly like that resource. So this means my costs as a business are going to reflect the value of resources either to their owners or to other entrepreneurs that would like to have those same resources. So taking this all in hand, what do profits mean? Right. Well, profits indicate that revenue is greater than cost. Right. Another way of saying that is the value to the consumers as a whole is high relative to the value of these resources in other uses, either by the original owners or by other entrepreneurs. In other words, if I'm profitable as a business, I am creating value. I'm taking low-value resources, relatively low-valued resources, and turning them into relatively high-valued products that people would really like to have. Losses, on the other hand, are value-destroying. It suggests that revenue is low, so consumers don't value what I am making very much relative to the cost. The cost then reflecting the value of resources and other uses. So put another way, if I'm taking a loss, I'm taking very high-valued resources and using them to produce something consumers don't particularly care if they have. In that case, I'm destroying value, and I'm actually, in effect, wasting these resources. Now, kind of a nice thing about this is that if we have a profit and loss system, resources will naturally head toward those businesses that are using them well. After all, if I'm using resources well, producing stuff people want, I'm going to be profitable. I can then take that money, those profits, and reinvest them in order to expand my business and to do even more creation of consumer value. On the other hand, resources will move away from those that are taking losses. Right? If my revenue is less than my cost, then I'm going to have resources flowing away from me. I'm going to find it more and more difficult to keep my business open. So it becomes actually a necessity that I will eventually shut down and stop destroying value. So on the whole, this process of profit maximization is actually desirable. What we want to do is allow those profitable firms to go ahead and expand, and also allow those firms that are not profitable, that are taking losses, to go ahead and shut down. That will allow us to use resources in the most high-value way, according to our consumers.